Oh dear. Well, there's always work for you in August in Edinburgh, if the corporate finance market dries up. So, and which it might do, you never know, but there is a bit of a gold rush at the moment. And I think the theme of today's closing session is corporate finance, a seller's market. So those of us in business, you know, the idea of selling, you know, maybe your first or second business is always attractive, but the key thing is about timing, isn't it? And the theme being, what makes now the right time to sell, conceptually, and also what's going on that's driving this sort of seller's market opinion, and who's active and why they're active, and what could businesses be doing now, this year, to get ready maybe next year to undertake a transaction. And so please just introduce yourselves. Nigel and Adam. Nigel first.
Good afternoon, everybody. My name's Nigel Cook. I'm the Group Managing Director for Evolution Capital. We started business in 2003, and we exclusively advise technology, that's TMT businesses, with corporate finance advice.
Thank you. Adam?
Yeah, Adam Zolden, Director at Knight Corporate Finance. We are fairly similar to Evolution, actually. We started in 2008, and we worked within sort of IT, telecoms, ICT sector. Specifically, we help companies with strategy, acquisitions, funding, and eventually exit.
Thank you. So given that the audience will, want to know what's going on, why is our sector at the moment so attractive? What's causing all the buyers to, is it just the classic, I need more revenue, it's easier to buy than grow organically, or is there something else going on?
I think there's two main reasons why businesses look to acquire. The first being is consolidation, where they're looking to do more of the same of what they do. The second reason is to enter two markets. So when we're dealing in a space like ours, which is quite small, entering new markets might mean picking up revenue streams that the acquirer doesn't have skills in that area, doesn't have a track record and traction. So currently today there's a lot of interest in cybersecurity businesses and Azure. These are areas which acquirers are looking for more skills, more traction, and therefore very compelling propositions for them.
So size is classic, yes? So
Yep.
What about your turnover, the EBITDA? Because some businesses are sold on multiple turnover. I hear sub $1 million turnover, let alone sub $1 million EBITDA. It's hard to find a serious buyer. Is that still true?
I think probably the sweet spot at the moment is $1 million EBITDA.
$1 million EBITDA.
That is the area which most of the larger mid-market buyers are looking to buy. But coming back to your point about and Adam discussed the importance of recurring revenue, and that is the main part of our sector, in that over the last sort of 20 years we've seen recurring revenues grow from 20% to some of the businesses we're now advising have a 90% figure. But I think we've also got to look within inside the pyramid, in that if you think in terms of a buyer, and when you're advising a buyer with buying your business, there's a pyramid stack, and at the top of it there's multiples associated with IPR, and then we come down and there's multiples associated with software revenues and managed services.
Yes.
And then we fall down to the bottom of the stack, where it's sort of one-off stuff, things like hardware, devices, that sort of thing, and connectivity somewhere in the middle.
Yeah.
So I think for anybody considering about selling their business, I think you need to understand the pyramid that a buyer looks at, because the multiple they're applying is made up of a blended multiple as to what's going in with your business. With regard to how do you, is it possible to move up the stack? And what's possible with getting better value for a business is about how much time you spend in preparing that business for a sale. So the longer you have, there's the more chance you've got of making changes and moving things up that pyramid. You know, if we're looking at, you know, sort of 6 months, then there are perhaps consultancy revenues that you can you know, perhaps dress up and change the way, you know, that some of those people are buying from you, so that they're you know, you can demonstrate that they're consistent over the years, and that can improve your value. You know, if you've got more time, then you know, and you're in managed services, then perhaps you can increase the amount of managed services that you're doing and reduce the consultancy, because after all, managed services is just a compilation of people providing a service. So you could look at those sorts of things. You know, IPR is something which, you know, is probably not a place where the normal business person can go to improve the value. That's a strategy and a long-term investment. So, you know, it's finding out where you are in that
stack. Thank you. Would you agree with that, Adam?
There are so many factors that could include.
It's his
that.
question now.
That's good. That's great, because I don't know how to answer it. Same as what Nigel said.
I suppose one has always got to consider the environmental factors, because those are things that are very difficult for us to control. And, you know, as Adam says earlier, you know, the pandemic hit, everyone went to ground, there was nothing going on for 3 months, and by the time we got to autumn, most of the players were back in, and they were ringing us up, all wanting to have this £1 million EBITDA business with managed services and 70% recurring revenue, and it was difficult to find those. So you know, those businesses were in demand. So the first thing is to you know, this is about is this the right time to sell? Is this a seller's market? Well, it is for certain businesses, because that some businesses are in very high demand, but other businesses, you know, are in lesser demand. So things that, you know, that 20 years ago, when we started, you know, selling hardware and software, those businesses in fact have dropped in value. Then you have the environmental factors, which I think we need to, you know, consider. In that, you know, in 2008 and 9 we had a recession, and the first businesses that really suffered from that, those of us had customers with finance and property, because those markets collapsed, and so the revenues and the earnings associated in your businesses with those sectors were at risk, and buyers, you know, wanted to avoid buying businesses that serviced those sectors, and the demand for them and the value of those businesses dropped. This recession, again, hasn't been uniform. It's been tough on some businesses, where, you know, as Adam said earlier, where businesses have been in the hospitality space, you know, the investors have run from those into our space, but where we've been serving businesses in the hospitality space, and you know, we've had a number of companies that we've been advising over the years that have, you know, one business completely focused on leisure. I mean, it's just not the time to sell that business. Their earnings are associated with a industry, you know, with a sector that is in immediate decline. So environmentally, you've got to consider those things. In the next 3 months, there's concerns at the moment with interest rates. There are concerns with supply chain. I mean, you know, I've just driven here from the south coast, and I managed to get some fuel on the 4th garage that I stopped. You know, I don't know whether this is a short-term thing, but there are concerns now that some of these supply chain issues might push us into the early part of next year, and you know, where that has effect across all of our sectors, those particularly serving utilities and fossil fuels, and you know, it can affect the service industries that
and confidence, of course, yes,
and confidence. So,
yes.
So you know, there are some difficult things ahead, and that's something that we as advisors cannot.
No.
You know, we're not. None of us could have advised around the pandemic coming.
No.
That was as much a surprise to us as it was to everyone else. So, I think those things, you know, you have to be wary of, and make your own mind up whether you think it's going to get better or get worse in the next 12 months.
Okay.
So,
But you did talk there earlier about preparing. And is that still as important now, given that there is a demand? Say you tick all those boxes that Nigel's talked about. Is it more important to prepare early?
it's always important to be present. So firstly, undoubtedly now is a great time to sell. But really the important question isn't that, it's when is the right time to sell for me. You know, if you're 1 year into a 5-year plan, then it's not. If, like some of our customers, they're 12 years into a 3-year plan, then it,
Yes.
it probably is. I mean, that's the first question. Start at the end, work out what you want and how you can get there. But yeah, the importance of preparation can't be underestimated. The likelihood is that if you're working in this sector, you'd have received emails or letters
Yes.
just saying...
Constantly.
Just saying there's an awful lot of activity around. It's the work that we do. I don't know how you feel. Sometimes I love it, generally enjoy it, but sometimes it's a roller coaster. And really the game that we're in is the certainty game. Transactions take anywhere typically between 4 and 9 months, I'd say. And they're hard work, there's a lot of resource involved, they're quite expensive, and what you really want to know is, if I go down this track, am I going to have a result? The likelihood is today that there will be some interest, but what the preparation will do, it will give buyers confidence and trust as you're effectively showing them, you know, they're asking questions and the answers they're seeing at the end are the same as that you told them at the beginning. And it's that level of preparation that just brings a level of certainty that actually it makes our job and the deal experience a lot more enjoyable.
Thank you. And I can say that that's correct from personal experience. So the last question before we go to the audience for questions is about what do I need to do now and what do I need to pay attention to in my own business as a business owner? And what tips could you give around that, please, briefly?
The first thing I think you have to ask yourself is what sort of process you're going to go through. So if you're a sub 5 million turnover value business, you're going to be doing perhaps something quite different to somebody who's plus 30 or 40 million. The preparation required is different because when you're being bought by institutional money rather than private and independent money, there's far greater due diligence that has to be conducted on your proposition. So the first thing is to understand, what size business am I, and how much do I have to prepare for a transaction. And then I suppose it's getting commitment around understanding why you have to commit to getting your due diligence in place. Is because if you haven't run this process before, you'll be perhaps thinking, all I want to do is agree a deal with a buyer, get to head of terms, and then the lawyers will manage it from there. I've got a great deal. I've got 20% more than I thought I'd get. If you're not prepared, then our research over 20 years shows you're probably going to go down 30% in the period from heads of terms to completion, because you're not going to better substantiate all of the things that you've said or your advisors said. And of course now you're in a position where they have the car keys, you've said goodbye to all of the other buyers of your business and you're talking to one party. So preparation is absolutely essential to be conducted, and it should start from the very beginning. You should start building a platform of information from when you as shareholders set your objectives right through to when you develop your information memorandum, from when you provide supplementary information to buyers in the data room, right through to the buyer investigation. It should be a growing level of information that you build over time, but you need to understand what sort of process you'll be going through, because it will be quite significantly different depending on who your buyer is.
Thank you. Thank you. Thank you very much. I'm going to throw it open. I have a couple of questions here from people who can't attend. Are there any questions for anyone in the audience? Mr. Sparrow there from Blabbermouth? I don't think, given the company's called Blabbermouth, I don't think you need a microphone, do you, David? But take it, go on.
So a lot of our customers, they often change to more short-term rolling contracts when they acquire new prospects, new customers. But a lot of the time they fear that actually they're going to lose value of their business if they do this. More often than not, those smaller rolling contracts stay for a longer period rather than sort of churn at contract length, a contract renewal. Does that have a big difference in terms of the value of a business if it's more sort of, rolling UC contracts rather than sort of traditional 36-month contracts, but it's all recurring revenue? Does that have a big impact?
Adam? Thank you, David.
I'd say, well, mobile's different, so let's park that one. If you've got low churn, then really it shouldn't make a major impact. Where it comes into play is generally we see companies have an 80-20 rule, so 80% of the revenue with the top 20% of the clients. And so if you've got those top 10 of your clients who are accounting for, say, half the revenue, then those are the ones that people are going to focus on. So look to get those locked in. But in terms of having a long tail of, apart from being very difficult to manage, if it's working, they're rolling along quite happily, and your churn is low, then it shouldn't have a material impact.
Thank you. So
I think that clearly, to answer your question, which Adam has done, the more recurring revenue you have, the higher the multiple you will get. A 20% business is going to get a low one, and a 90% is might get 8, 9, or 10, even those sorts of numbers. The decision that you as shareholders got to perhaps make is if I'm going to go on a short-term run between trying to convert over some of this low-level stuff that's worth 2 or 3 times to something that's worth 5 or 6 times, that's probably going to be a cost to me, because I'm going to have to go back to my customer and say, look, you're on a 1-month contract. If you sign up with me for 3 years, I'll give you a discount. So you've got to have to calculate, is that worthwhile? The way perhaps that you might go about that is if you're converting revenue from 2 times multiple to 6 or 7 times multiple, and you have to give away 10% of that revenue, you might be getting 3 or 4 times what you're giving away. So it needs to be put through a spreadsheet, and that's what people like us do. But by every time you take cost out of a business, you can multiply it by the multiple. Every time you improve the quality of earnings, you can move up the stack, up the pyramid. So I think that probably does that. But you don't have to think about improving your quality of earnings just by recurring revenue in terms of how long my contracts are, because a business that has got a stickiness of its customers, where perhaps we've got some customers we've moved from having 1 or 2 services into one customer to having 12, and they're all on different contracts. So a buyer looks at that and goes, these guys aren't going anywhere. Okay, they're only on 30-day contracts, but do you know what? We don't really care, because that is, they're loyal customers, and they voted with their feet by buying more and more things from this business.
Thank you. Any more questions? We've got 5 minutes or more. Mr. Trim.
Yes.
The microphone's coming, Neil.
Hello.
Yeah.
Regarding employees, how important are retaining employees in the business when you sell it? Because you often hear directors are told to make yourself redundant so the business is sold and it's more sellable. But the actual core employees, how important is it to secure those services as it moves into new ownership?
I think employees are becoming, and skills right now are becoming, high value items in a business. Yeah. We've got a situation in our economy now where we all know we're short of staff. We're trying to employ staff. Look at the quality of people that turn up for interviews. It's difficult, isn't it? Getting people in, and those people want more and more money. So you know, it's always been a case where, you know, people see a pool of skills and they go, you know, I want to buy that. We had a client, a very small client, you know, who had a business that made, you know, well below $1 million EBITDA. We're talking, you know, right at the other end of the spectrum, and it didn't look like the sort of business that we would sort of normally advise. But once we'd done a review of the business, we could see that this business had half a dozen really top technical skilled guys, all in this telecom space within a couple of big vendors. And then they serviced sort of the great and good through an indirect model of the mid-market, you know, the ones I won't mention that we all know. So suddenly you could see, well, you know, this business is going to be really high value. And the multiple that it achieved was higher than IPR businesses that we've advised. So right now, people are high value. You know, there's nothing ever better than quality of earnings. But I would say, Neil, you're right on it there. Skills and people are of great value right now.
Thank you, Nigel. Good question. Adam, maybe briefly on that?
Yeah, I guess talk about directors, shareholders. Certainly, so that those customer-facing people are very valuable. It's going to vary buyer by buyer what the attitude they take in terms of, you know, many are going to try and look and achieve some cost savings. And in terms of, you know, directors and shareholders who are selling, we ask what they want out of a deal. So some people, you know, for example, if they're just looking to retire, we can normally negotiate them out pretty quick. If they're thinking, well, actually, I've got a bit of growth left in the tank here, and I want to see it through, we can normally negotiate a deal that will have that as well. So from the director stroke shareholder perspective, you can make that call before you start on that process.
Thank you. Thank you. Last question, anybody? Gentleman at the front, thank you.
We spoke a lot about EBITDA.
Here's your mic on.
Yep. So we spoke a lot, or you guys did, about EBITDA and multiples. Is that still the way that people within the managed space are being valued? Because we tend to see a lot more by way of metrics and matrices where they're taking sort of KPIs of turnover, net service, recurring revenue, rather than just looking at a multiple of EBITDA?
It is EBITDA. The whole market's driven by private equity, and private equity is their metric.
Is looking at that.
So the typical metric will be they'll go in at a multiple of, say, 10. They'll try to buy a bolt-on at a multiple of 6. By the time they've taken cost savings out, it'll be 4. And they'll look to flip the whole lot for 14 3 years down the line. So, you know, when companies are not making much profit, typically owner-managed businesses, then you can bring other metrics into play. Yes. But yeah, I'd say EBITDA, unfortunately, because it's a bit of an annoying word.
So, but when you're looking out with private equity, so let's say you're looking at that EBITDA million mark again, that isn't necessarily in the private equity space, but would tend to be more in the independent to independent sale/purchase. What sort of matrix, what are they valuing on? Do you tend to find they're still looking at EBITDA simply because it's what they know, it's what they expect, it's what's been spoken about, or are they looking at it slightly more intelligently and saying, well, actually, you know, a multiple of current revenue isn't going to value a cross-sale opportunity?
It depends on the type of deal. Are you talking as a buyer or a seller, for example?
A buyer. What's my best method to value low?
Well,
okay.
Sorry, Nigel.
No. Go.
So, you know, it's again, what are you looking at here? Are you looking at if you're looking at just a customer base, here's a recurring revenue customer base, I can just lift and shift that into there. Then, you know, common recurring multiples of monthly or multiples of recurring monthly gross margin. It's quite a typical one, and it sort of was used regularly but it's sort of less likely.
Yeah, I mean,
now.
as a buyer, what's really important for you as a buyer is the cash that target makes. So when you're looking at it, what you want to know is what's its, what cash does it make? So we can forget about, depreciation and all that sort of stuff. And if that business makes that much cash, you know that with that money, that's what you're going to use to pay this thing off, over how many years. So for you, when you're looking at EBITDA, but you also need to look at gross profit, because if the target you're buying, and we've been involved with deals where we have removed 90% of the overhead.
Yeah.
So what that means is the gross profit is going right through to the bottom. So EBITDA suddenly becomes less important because it's actually the gross profit, because that's what you're now taking down to the bottom. So as a buyer, you need to, there's as Adam said, there's lots of other things you need to look at, but I'd say those two areas: what's the current EBITDA, and how will that improve by the adjustments you're going to make?
Okay. Just one last multiple, which I think is probably the most important one, really, which is how many years' work do I get out of this deal? If you're talking to a shareholder that's built their company over a period of time, let's just say it turns over £1 million and makes 400k gross margin, and every year they take 150k dividends out. After tax, they're sort of sub 100, let's say 90 grand. Now, if they've got 400k gross margin, and as Nigel said, that could fall to the bottom line, you might think you could afford, say, 2.5 times that, £1 million. Because on that, they'll only pay 10% capital gains tax, that's 900k. So in one hit, they've got 10 years earnings.
10 years money.
And that, I think, is quite a powerful, from both sides. It's not just a selling tool, certainly. So
yeah, you want to minimise your tax liabilities as
we're
seller as well.
so we actually sold Knight Corporate Finance a couple of months ago. We're locked in for 5 years and we'll continue to trade. But yeah, that was certainly the thing I looked at. If how many years can I continue to look after myself if everything goes wrong?
Okay. Thank you. Thank you very much. We've got through the whole session without mentioning tax until just then. Which is
I know.
Yeah. And without my headphone falling off, because I was given one for somebody about that size.
You command the room, Nigel. You command the room. So if there's no more questions, I'll wind it up. Any more questions from this eager, enthusiastic audience? No? All right, then we'll just please you to thank you all for attending. Would you just give a round of applause to Nigel Cook and Adam Golden, please? Thank you.
Evolution Capital is the first UK corporate finance boutique to exclusively focus on providing advice to the ICT sector. We are the leaders in our field. With activities spanning 3 decades, we have provided strategic and transactional advice to over 200 technology entrepreneurs, shareholders and management teams of both privately owned and public companies. We deliver outstanding transactional outcomes by unlocking intrinsic value in our clients' businesses, by providing expert advice based on meticulous analysis and robust methodologies. This is who we are and how we do it.